Hello everyone, my name is Radovan Vojtko. I'm CEO and Head of Research at Quantpedia. So what is today's topic? Today we will discuss reversal and reversal strategies. There are quite a lot of them. It's a popular style or trading style. We have around over 100 of them in our database. How does the usual reversal strategy look like? We have two types of the reversal strategies. One is cross-sectional, another one is the time series. So in a cross-sectional reversal strategy, you have a pool of assets, 20 or 40 assets. You are periodically buying those that are the weakest one, so that are performing the worst, and you are selling those that are performing the best. So this is the cross-sectional. The time series reversal strategies are those in which you look at just one asset, for example, Bitcoin, or high yield. So in this case it's high yield market, and you buy the market when the market is a weak one, and you sell or do not hold the market in case it's a strong one. So the time series reversal in the case of one market is a market timing strategy, and we will try to revisit this market timing strategy, the reversal effect, and we will check it out for the US equities for SPI, and we will try to find out how to build this reversal strategy better. If you are interested in this kind of the trading, I recommend you to visit the overnight reversal effects in the high yield market, where we discussed the reversal strategy for high yield, and here is the trend following and mean reversion in Bitcoin. So there are two other articles that are related to this, but in this time we will just focus on S&P 500 or the SPI ETF. These reversals, they often occur in response to the brief period of the market stress. So we have a sharp declines in the market, and they are followed by the quick recoveries. This is what we were experiencing in the last few weeks. We have a Trump as a president in the United States, and the moment there is a trade war with China, and one day there is a trade war, another day there is not trade war, and then once again there is a trade war, etc. So the markets are going up and down, up and down, up and down. So the traditional approach, how to identify stress periods and when to find the price point, when to buy the underlying asset, is using the price action of the equity index itself. So when we are trading the equity index, we are just looking at the equity index. However, there is a better way how to do that, and in this research we are exploring the broader perspective. We are leveraging the behavior of other assets. So we are including the gold, oil, and intermediate term US treasuries, and we show that using the signals from these correlated assets to detect stressed events.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports, and save hours of work. Quantpedia Pro, your edge in quantitative investing.
Can enhance the timing and robustness of reversal trades in equities. So what does it mean? That we can use other assets, not just the equities, and time the equity market, and we will have the better trading strategy. Okay, so how to get into that? So we are checking 5 primary asset classes. We are using the ETFs for that. So we are trading the commodities, the oil, precious metals, the gold, fixed income, which is using ETF IEF 7 to 10 year treasuries, equities by ETF SPI, and then we are checking the currencies, bullish US dollar ETF UUP. So our data sample starts in 2004 or 2006 and ends in 2025. Okay, so what is our idea? So we employ a dynamic threshold model. So we identify the stress events, and the stress event is defined as a simultaneous one-day decline in 2 risk-on assets. So we can split our assets into risk-on and risk-off. So risk-on asset is the asset we usually buy when everything is fine. So it's like US oil or SPI equities. So what we are looking at is, what if we define the signal as a stress even not just in one asset but in 2 assets simultaneously? Or in other way, so we have a decline in one risk-on asset like SPI, and the appreciation in the risk-off asset, the risk fixed income, so the US government fixed income. So what does it mean is the US government bonds usually react very strongly when there is a sell-off in US equities. So in case there is a sell-off in US equities or sell-off in gold or in US oil, and at the same time there is appreciation in the US treasuries, we can have a very great buying signal. So altogether we can build 6 signals: depreciation in gold and equities, depreciation in oil and equities, oil and gold, or we have appreciation US treasuries and depreciation in gold. So up move in US Treasuries and down move in equities, and up move in US Treasuries and down move in oil. So I mean, in the first three we are using only the risk on assets, and in the last three we are using the risk on and the risk off asset together. Then there is a question about what parameters should we use. I mean, what is the sell-off in equities? It's -1%, -2%, -3%, 0%, less than 0. So there are like a lot of the ways. What we will find out at the end is the best parameter is the sell-off between 0 and 0.5%. So if there is a worse performance than 0.5% in the US equities, and at the same time there is a sell-off -0.5% in oil, this can be like a good trigger to buy the US equities. So this is how does it look like. So we have 6 strategies that we tested, and then we are testing what is the next day reaction in all of the ETFs, so in the oil, gold, SPI, dollar, etc., etc., after the gold and equities decline together. So here we see the blue line is the SPI, and the SPI reacts very strongly. So if we have the decline in gold and the equities one day, the next day there is usually strong performance in the SPI. Then in the second case, if we have the negative performance in the oil and equities, and the next day we have usually positive performance in the US equities. Once again, if we have the negative performance in the oil and gold simultaneously, the next day we have the positive performance in the US equities. Okay, once again, if we have the positive performance in the US treasuries and negative performance in the gold, we have usually the day after that the positive performance in US equities. Once again, we can have a positive performance in US treasuries, negative performance in US equities, and the next day we have positive performance in US equities. And the last time, so we can have a positive performance in US treasuries, negative performance in the US oil, and the next day we have positive performance in US equities. So what we can see is that SPI is a great asset for the reversal strategies because it strongly reacts the day after the market stress. The only thing that we need to do is to build the proper signals for when to buy the SPI. So here we have a threshold variation. So we run also the robustness analysis, and what you can see here is that what I mentioned before, we can have like different thresholds, and what is usually the best thresholds for the sell-off is between 0 and minus 0.5% move for the risk on asset, or between 0 and 0.5 move for the risk off asset. So these are the thresholds which are usually the optimal. As we can see here, SPI usually reacts very well. So what we can do is we can diversify among those signals. So here is just an easy example. So we can take 3 last strategies, so the strategy number 4, 5, and 6, and we can combine them all together. So once again, we will buy SPI if one day increase in US treasuries and simultaneously there was a one day decrease in the gold the day before, then we will buy the SPI, or we will buy SPI if there was one day increase in the US treasuries and at the same time one day decrease in the US oil, or we will buy the SPI if there was one day decrease in the US treasuries and simultaneously one day decrease in the SPI. So these are like 3 underlying strategies, 4, 5, 6, and we will combine them into one final strategy. What is the advantage of the final strategy? So we have diversified signals. We are not just using the signals from the SPI itself, we are using the signals from all other asset classes. And what we see is that in this case we have the better performance, better Sharpe ratio, smaller drawdown, etc. We have like more signals and they are diversified from each other. Once again, the SPI or US equities, they react very well, so we can build the reversal strategy on the underlying asset. It makes sense to include other assets than just US equities or SPI ETF for the signal calculation, because the resultant strategy is more robust, the signal is better, etc., etc. It really makes sense to build the signals not just from SPI but also from the other asset classes, and then combine those and build one correlated stress reversal trading strategy. So I hope that you liked the article. Once again, there are a lot of the trading strategies like that in our database, so you can use the keyword reversal, you can find a lot of the ideas in our database, or you can visit our blog and review the strategies there, or read our paper. If you liked the video, please give us the like, subscribe to our channel, follow us on our social media channels, or subscribe to our newsletter. So thank you very much, and I hope that I will see you in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.